George of the jungle, strong as he can be.
Okay folks, so we're going to do a little bit of myth busting today, and there's been a lot of, sometimes you see builders or sellers or lenders advertising that you can put down less than 20% and not have mortgage insurance. Is that an incorrect or a false statement? Well, technically it's not. But how you get at the numbers is something that we're going to dive into today at thecreditjungle.com. My name is George Anderson. And again, been at this for quite a while, and I want to share just the mechanics of how that works, because as you know, a lot of the purpose of advertising is to initiate a phone call and get you to talk to somebody. Once you talk to somebody and you figure out what the real deal is, the numbers don't always look so good. So this is your opportunity to shop and get the numbers in a very innocuous way. So let's just go and take an example here. We have a concept called single premium mortgage insurance, and that could either be paid by the lender or it could be paid by the seller. And I'm going to just focus a little bit today on the lender side of how that works, because we're in a competitive market right now, and to ask the seller to pay closing costs and to be able to pay a single premium for the mortgage insurance may not be a tenable proposition to a lot of the sellers. You're looking at closing costs being, they could be in excess of 3%. So let's just kind of stick with some numbers that are probably more plausible in the market that we have right now. But we're looking at a $350,000 purchase price of a home. We're going to put down 10%. And in this scenario, for these numbers, we're going to assume that the buyer, if you're the buyer, that you have a credit score that is in the 720 to 739 range. So just one notch below kind of the top tier, 740 above, but obviously still very, very good credit. And we're going to use 10% down as an example, because with 5% down, the numbers are just so ugly it doesn't even make sense. So I'm not even going to get into writing an example that way, but we're going to look at a 10% down proposition here. So if you're putting down 10%, you would have, these are just some estimates using some current numbers. The market's volatile. There's going to be a lot of fluctuation on this, but at a 3.5% interest rate, the monthly mortgage insurance premium for somebody with 10% down and having the 725 credit score would be 0.39%. That is a monthly mortgage insurance, and as we talked about in a prior video, you're probably stuck paying that for a minimum of 2 years before you can contact the lender, demonstrate that you have enough equity, and request to have that mortgage insurance removed, which if they agree to do it, they just literally stop collecting the $102 per month. So here you'd have your principal and interest payment of $1,414.50, another $102 a month for your monthly mortgage insurance. That's an additional payment on there. But then you say, okay, well, how do they make it work? Because I was told that I can have a loan and not have that mortgage insurance. Well, that's correct. So if the lender is offering to do that, the way that the lender does that is they will charge you a higher interest rate. So the question becomes, how much higher is that interest rate, and what is the impact on your payment? At the end of the day, most of the buyers that I sit down with, they don't really care how we get to the payment. They want to know, what do we have to do to get that payment to the lowest possible term that we can. So the no mortgage insurance, a lot of times it initiates somebody to make a phone call to call in, but then when you start looking at the numbers, you're like, oh, well, this is really a horrible deal. Well, let's figure out how horrible it is, and this is using pricing here. This is April of 2020, and again, these metrics, these change a lot, but this is fairly close proximity on here. For the lender to pay your mortgage insurance, they're going to have to offer you an interest rate a full 1% higher than if you paid it on a monthly basis. Well, if you do the math on it, that payment there is going to be $1,596 a month. And if you look at over here, you're $1,517 a month. So we're really looking at, this option here is an extra $80 per month to be able to respond to having the lender pay your premium on that. Not a good deal. Now let's just say that, well, you still like that idea and you still went ahead with it. The next question is well, how do you stop paying that mortgage insurance? Because guess what? This has been priced into your interest rate of your loan. So you're at 4.5% right now. What happens if the interest rates have gone up a little bit after the time that you bought your home? Because they say, well, you can always refinance and be able to get a lower rate. What if you don't have that opportunity? Where would you rather be? Would you rather be at 3.5%, knowing that you have an option to drop this $120, $102 a month? Or would you rather be here? Because if the rates went up to 4.5%, well, you're certainly not going to refinance to 4.5% to get rid of something that you never had in the first place. So you're stuck with this. And if you refinance early and if the rates did go down and you pay it off, guess how much of the mortgage insurance premium that the lender is going to refund to you? I bet you guys can guess. You're right. The answer is 0. You will not get any of that back. Just like here, you wouldn't get any of this mortgage insurance premium back here if you've paid it over 2 years and you can eliminate it. They'll just quit collecting it, but you're not going to get it back. This is another 1.5% cost that the lender is incurring. So the lender is actually going to be shelling out on this loan. They're going to be shelling out about $4,700 to pay that single premium on your behalf. Well, the only way that they can do that without charging you a closing cost and having it come out of your pocket is to increase the interest rate. Well, a 1% interest rate increase on here is less than increasing it for 0.39 because your effective interest rate here is 3.89. That's with the mortgage insurance, and this portion of it is not permanent, it's temporary. So you can have some situations where if the seller pays this 1.5%, if you have the wiggle room in a transaction, sometimes it can make sense to do that because then you could have the same interest rate, collect this additional $4,700 from the seller, but more than likely you're going to be adding that into the sales price of the property and building that in. So I know that this is a little bit of a dive into the weeds, but there's some people that really like to do this. And for those who do, here's your numbers, here's how it works, and hopefully this has been good information for you. This is George Anderson. Thanks for coming into thecreditjungle.com today, and I hope to see you soon. Yes, and you can come in now.
Sorry.
That's all right.
I like